Welcome back. Let's get straight into it because the clock is ticking and this is not just another routine update. We are officially inside the final 96 hours, and if you've been paying attention, you already know why that matters. This is the window. This is the stretch where negotiations either solidify into something real or they completely fall apart. There is no more middle ground after this. The whispers are getting louder. Conversations are happening behind closed doors. Deals are being shaped, revised, pushed, and challenged, and by the time this week closes, we will have clarity one way or another. I told you last week would feel slow. I told you it would feel like nothing was happening on the surface. That's because the real work was happening privately. XRP family, this is the week everything becomes visible. By Wednesday, we should have direction. By the end of the week, we should have confirmation. Now, let's talk about why these 96 hours are urgent. This isn't hype, this is timing. We're looking at 4 days where political pressure, market positioning, and institutional expectations are all colliding at the same moment. You can check prediction markets, you can check social media sentiment, you can check analyst probabilities, but understand something very important. Those odds shift based on headlines, not based on what's actually happening in negotiation rooms. And what's happening right now is intense. The administration is no longer playing soft when it comes to crypto policy and banking resistance. The tone has changed. The posture has changed. It's no longer exploratory, it's decisive. But here's where it gets complicated. Bipartisan negotiations are never simple. We're hearing there's been a major push from some lawmakers to attach provisions that could intentionally derail the bill. What some are calling a poison pill. That's real political strategy. Add something controversial, make it impossible to pass, and then blame the other side when it collapses. That's the game, and that's the risk inside these 96 hours. At the same time, macro noise is swirling around us. The tariff situation was always expected to face legal resistance. Experts have been saying for months that the structure was vulnerable. When the Supreme Court signaled issues, the market didn't panic the way people thought it would. In fact, it moved higher. Why? Because uncertainty had already been priced in. The administration's public frustration almost confirmed that they knew the ruling direction ahead of time. Markets are forward-looking. They adjust before the headline hits. So when people expected chaos, what they got was relief. Now we're looking at a revised 15% tariff framework, reportedly temporary, possibly capped around 150 days. That's negotiation leverage, not permanence. So here we are. Political tension elevated, crypto legislation at a decisive point, markets positioned cautiously but ready to move. This is what convergence looks like. And whether you're bullish or skeptical, you have to admit something big resolves this week. Either we get legislative clarity and momentum accelerates, or we get disappointment and volatility spikes. And there is no quiet ending here. Stay focused. Watch the signals, not the noise. Because when this breaks, it won't move slowly, it will move fast, and you'll either be prepared or reacting. All right, first things first, before we get into the charts and the chaos and the rumors and the probabilities, you already know what I'm going to say. If you want to follow these moves in real time instead of hearing about them after the fact, the membership link is right there. The earner tier is where I post my options plays, my regular swing setups, my portfolio adjustments, and the live sessions where we break down zero DTE strategies step by step. It's not just alerts, it's teaching. It's understanding why the move is happening, what invalidates it, where the risk is, and how to size it. Thousands of traders are already inside, and the reason they stay is because they're not guessing anymore. They're executing with structure. Now let's talk about what's happening right now because this is one of those weeks where something breaks. At the time of recording this, prediction markets are hovering around a 70+% probability that regulatory progress moves forward. 70% sounds high. It sounds comfortable. But probability is not certainty. We have seen heavy favorites lose before. Markets price expectations, and when expectations are wrong, the repricing is violent. Pull up the weekly chart. Big red candle down. Small relief, bounce. Another controlled drift lower. That pattern right there is compression. If price breaks below the recent weekly low, that's a continuation setup and it opens the door to a fast move lower. I'm talking about a rapid flush toward the 90 cent to 115 zone. And it wouldn't be slow. It would be emotional because the move is tied to expectations around the Clarity Act. That support sitting underneath price right now is not random. It is built on the assumption that something gets finalized. If that assumption breaks, support becomes air. Now, here's the other side. If negotiations progress, if we see movement, if markup scheduling happens, that same support becomes a launch pad. That's how this works. We are sitting at a decision node. Reports suggest banks and crypto industry leaders are working against the clock to finalize language, particularly around stablecoin yield provisions. There is pressure to get something structured this week. No major participant benefits from indefinite limbo. Banks want clarity. Crypto firms want durable rules that survive election cycles. The tension point appears to revolve around Section 404 and whether idle stablecoins can generate yield. Banks are worried about deposit migration. The crypto side wants competitiveness. Activity-based rewards may be the compromise, but the wording has to prevent loopholes. That's the negotiation. Meanwhile, there are discussions around ethics standards tied to digital asset exposure by public officials, and that adds another layer of friction. This is where timelines matter. If movement happens early, momentum builds. If it stalls, volatility increases. And all of this is happening while the fear index is sitting at levels we haven't seen in years. Historically, those levels mark bottoms, but only if structure holds. That's the week we're in right now. When you zoom out and really think about what is happening beneath the surface, you start to realize this is not just a price story, it is a positioning story. Large players do not move billions based on headlines alone. They move based on forward probability curves, capital efficiency, and regulatory durability. Right now, what makes this moment unique is that the market is pricing in partial success. Not full certainty, not full failure, but partial success. That creates tension. If you look at the daily structure, you can see liquidity resting below the recent lows. That liquidity is attractive. If price sweeps that level and snaps back quickly, that becomes a bear trap. If it sweeps and accelerates, that becomes confirmation of weakness. The key is reaction speed. Institutions watch reaction speed more than the level itself. Now layer in macro. We have continued debate about rate path expectations. We have tariffs in the background. We have stimulus speculation quietly circulating again. Liquidity conditions matter for risk assets. Crypto does not trade in a vacuum. When liquidity expands, speculative assets breathe. When liquidity tightens, leverage suffocates. And right now, liquidity is uncertain. That uncertainty feeds volatility. The Clarity Act discussions are acting as a catalyst, but they are not the only variable. There is also the broader narrative around 401k crypto access. If long-term retirement vehicles gain structured exposure pathways, that is a demand unlock. Not overnight, but structurally. Pension flows are slow, but they are persistent. Markets front-run persistence. This is why the support level we're sitting on is so critical. It is not just a chart line. It is the line between structural optimism and accelerated doubt. If we hold and bounce, the first resistance cluster sits above at the recent breakdown point. A reclaim of that level shifts momentum. A strong weekly close above it flips sentiment quickly because traders are currently positioned defensively. Short interest has increased, funding rates reflect caution. That creates squeeze potential. But if we lose support cleanly, the 90-cent region becomes magnetized. That zone aligns with previous accumulation and high-volume nodes. It would likely trigger forced selling before attracting fresh capital. Emotion would spike, social sentiment would turn aggressively bearish, and ironically, that's often where long-term reversals begin. Markets exhaust sellers before they turn. The fear index is flashing extreme readings. Historically, extreme fear has preceded strong rallies, but again, only if the structural low holds. That's the conditional. So when you hear 70% probability, don't hear guarantee, hear tension, hear coiled spring. Because that is what compression looks like right before resolution. This is the calm before directional commitment, and the direction will likely define the next multi-month trend. Now let's talk specifically about the negotiation dynamics because this is where nuance matters. Section 404 has become the focal point, not because yield is inherently controversial, but because of what yield represents. Yield represents competition with traditional banking deposits. If stablecoin issuers are permitted to generate passive return on idle balances, that changes capital allocation incentives. Smaller banks are particularly sensitive to deposit migration. Large institutions have diversified funding channels, but regional banks rely heavily on deposits, so the concern is systemic stability. On the other side, digital asset firms argue that without yield functionality, stablecoins remain limited in competitiveness compared to money market instruments. That is, the tension, activity based rewards are being discussed as a middle ground. Instead of passive yield, incentives tied to network participation or transaction activity could be structured in a way that avoids direct deposit competition. The wording has to be precise. If it is vague, regulatory arbitrage emerges. If it is too restrictive, innovation slows. Meanwhile, there are ethics considerations being debated regarding digital asset exposure among public officials. Some argue parity with existing securities rules is sufficient. Others believe digital assets require additional disclosure standards. These layers complicate timing. Timing matters because markets react to scheduling signals. If markup dates are announced, optimism increases. If delays are hinted, volatility rises. That is why this week carries weight. The White House has signaled a preference for forward motion, but preference does not equal outcome. Political calendars, committee processes, and negotiation leverage all intersect. And while all of that unfolds, price sits directly on a structural pivot. That intersection is rare. Macro uncertainty, regulatory debate, and technical compression converging at once creates explosive potential energy. Traders need to understand that reaction, not prediction, is the edge. If confirmation appears, you ride momentum. If invalidation appears, you protect capital. The market will reveal the answer soon enough. The only mistake is assuming the answer before the market confirms it. Patience at inflection points is not weakness, it is strategy, and right now, patience combined with preparedness is everything. Let's shift toward the broader macro overlay because ignoring it would be a mistake. Even if regulatory clarity progresses, the liquidity backdrop still determines magnitude. The Federal Reserve remains cautious. Inflation data has cooled in pockets, but remains sticky in others. Rate cuts are discussed, then walked back, then discussed again. Markets oscillate between optimism and restraint. When rates stay higher for longer, risk assets face valuation pressure. When easing expectations build, speculative appetite returns. Crypto sits at the high beta end of that spectrum. Add to that the conversation around tariffs and trade tensions. Tariffs impact supply chains, input costs, and corporate margins. Corporate margins influence equity performance. Equity performance influences risk sentiment. Risk sentiment bleeds into crypto. It is all connected. There's also quiet talk of targeted stimulus measures if growth slows more than expected. Stimulus expands liquidity. Stimulus expands. Expanded liquidity historically benefits alternative assets disproportionately. So we are in a macro environment that is neither fully restrictive nor fully accommodative. It is transitional. Transitional environments amplify catalysts. That is why the Clarity Act narrative feels amplified. It is landing in a market already searching for direction. Now look at on-chain data. Exchange balances have declined modestly, suggesting reduced immediate sell pressure. At the same time, derivative open interest has risen, indicating speculative positioning. Rising open interest into compression increases the probability of a volatility event. The question is direction. If we see a decisive reclaim of the breakdown level with strong volume, that likely triggers short covering. Funding flips positive. Momentum traders pile in, that could accelerate a move back toward the mid-range highs. Conversely, a breakdown with expanding volume would confirm distribution, stops cascade. Leverage unwinds. That is when the 90-cent zone becomes realistic quickly. Remember, markets move fastest when narratives flip. If optimism converts to disappointment, speed increases. If skepticism converts to relief, speed increases. Either way, compression does not last forever. The fear index sitting at multi-year lows suggests participants are already defensive. Defensive positioning reduces marginal sellers. Reduced marginal sellers can create asymmetry to the upside if good news appears. But if bad news hits, the thin liquidity pockets below can exaggerate downside. This is why risk management matters more than conviction. Conviction without risk management is ego. Structured exposure with defined invalidation is discipline, and discipline is what survives inflection weeks like this. Now consider the longer-term structural implications beyond the immediate vote probability. If regulatory clarity advances in a durable way, it sets precedent. Precedent reduces existential risk. Reduced existential risk lowers required risk premium. Lower risk premium supports higher valuations over time. That is not hype. That is capital markets logic. Institutional allocators require clarity before committing size. Even a framework, even if imperfect, reduces ambiguity. Ambiguity is expensive. It demands discounting. Remove ambiguity, and multiples expand. That is why this debate matters beyond this week's candle. There is also the retirement account angle. If structured pathways open for retirement funds to gain compliant exposure, that is slow capital. Slow capital is powerful because it does not trade daily headlines. It accumulates methodically. Over time, that accumulation can underpin floors. But again, timelines matter. Implementation always lags legislation. Markets anticipate implementation. So, if progress is visible, price may move before flows fully arrive. That anticipation is what traders are trying to front run right now. Meanwhile, technology continues evolving. Layer upgrades, interoperability discussions, enterprise integrations all continue regardless of legislative pacing. Fundamentals do not pause for politics, but price often does. That disconnect creates opportunity for those who differentiate short-term volatility from long-term trajectory. The weekly structure we discussed earlier is the battlefield between these two horizons. Short-term traders are focused on the next two candles. Long-term allocators are focused on the next 2 years. When those perspectives collide at a support level, volatility expands. That expansion is not random noise, it is capital rotation in motion. If you see strong buying absorption on dips with declining volume on sell-offs, that suggests accumulation. If you see heavy volume on breakdown with weak bounces, that suggests distribution. Read the tape. Do not read social media sentiment alone. Sentiment can mislead. Order flow rarely does. We are at a point where both outcomes remain viable. That means flexibility is strength, bias is weakness. Let the market confirm, then deploy aggressively in the confirmed direction. That is how you survive and thrive in transitional phases like this one. Let's also address psychology because markets at inflection points test emotional discipline more than analytical skill. When probability is high but not absolute, anxiety increases. Traders start front-running outcomes. They size too big. They ignore invalidation levels. They convince themselves certainty exists where only likelihood does. That is dangerous. 70% probability still leaves 30% room for surprise. If surprise hits and you are overexposed, emotion overrides logic. That is how accounts get damaged. The correct approach here is scenario planning. If we hold support and reclaim resistance, what is the upside pathway? Map it. Identify profit-taking zones. If we lose support with volume, where's the next liquidity pocket? Identify it. Decide in advance how much you are willing to risk. That pre-decision prevents panic. The fear index being historically low suggests many participants are already braced for downside. Ironically, extreme fear often precedes relief rallies because sellers exhaust themselves. But fear alone is not a buy signal. Structure plus fear is compelling. Structure breaking plus fear is confirmation of weakness. Distinguish between the two. Also understand that headlines may leak in fragments, early optimism, sudden doubt, late-night statements. Volatility around news windows increases slippage risk. Adjust position sizing accordingly. This is not the week for reckless leverage. It is the week for calculated exposure. Markets reward preparation. They punish impulsiveness. And remember, even if a negative outcome materializes, markets overshoot both directions. A sharp flush toward the 90-cent region, if it happens, would likely create one of the best risk-reward opportunities in months for those prepared. Conversely, a strong breakout reclaim could initiate a momentum phase that forces sidelined capital to chase. Either way, opportunity exists. The edge is not predicting the outcome with ego. The edge is responding to the outcome with discipline. Keep your process intact. Keep your risk defined. Let volatility work for you instead of against you. That mindset shift alone separates consistent traders from emotional participants during weeks exactly like this. Finally, step back and recognize the magnitude of convergence happening right now. Regulatory debate, macro uncertainty, technical compression, sentiment extremes, and institutional positioning are all aligning at the same price region. That kind of convergence does not occur every month. It is rare. Rare moments produce outsized moves. Whether that move is up or down depends on confirmation, but the magnitude potential is clear. If clarity advances and we see follow-through buying, momentum algorithms will engage, short positions will unwind, volume will expand. That combination can fuel a sustained multi-week push higher. If clarity stalls and price slices through support, liquidation cascades could accelerate decline before value buyers step in. In both cases, speed increases. Speed creates opportunity for those positioned correctly and risk for those positioned blindly. Remember that markets are forward-looking. By the time official announcements feel obvious, price will have already reacted. Watch the levels, watch volume, watch reaction speed. Those signals matter more than commentary. Also understand that long-term adoption narratives do not disappear because of short-term volatility. Infrastructure continues building. Institutional research continues progressing. The digital asset ecosystem evolves regardless of weekly headlines. Short-term traders trade candles. Long-term investors accumulate structure. You need to know which category you are operating in. Do not confuse a swing trade with a retirement thesis. Define your time frame, execute within it, and as this week unfolds, remain calm. Volatility is not your enemy. Lack of preparation is. The market is about to choose a direction. When it does, move with it, not against it. Stay disciplined, stay objective, and let confirmation lead conviction instead of the other way around.